Guys, there is an ETF that can beat both SPY and VOO over long periods of time. And I'm going to show you why you may want to look at this one to add it to your portfolio. Now, people who've watched this channel know that I'm a big believer in SPY or VOO. This is SPY. Net expense ratio, 0.09%. Dividend yield, 1.23. But the real reason is, over time, the market's going to go like this, but the price is going to go like this. So the best way to get the market return is dollar cost average. And I always say a low cost market-based ETF. But lately, something interesting has happened. The top companies in the stock market have driven all the returns. So of course, being the contrarian that I am, I thought to myself, yeah, but everything else is going crappy. What does that mean for the overall market? So which led me to find a very, very interesting ETF called the S&P Equal Weight ETF, ticker RSP. Let me show you right now some of the differences. Now, RSP has a higher expense ratio. They also do a little more work. Look at this dividend yield, 1.55. Why? It takes every company in the S&P, and every quarter, it readjusts all of its portfolios so that every single company is equal in these portfolios. So it accounts for 0.2% of the portfolio every quarter. Now, the downside of this is when you see these massive jumps in a certain number of stocks, small group of stocks that we've seen from the Magnificent Seven over the last 3 years and other companies, it causes kind of a way of losing out on that gain. Let me show you what the last 3 years have looked like from RSP versus SPY. RSP is here in purple, SPY here. Big difference. This doesn't include dividends, by the way, but it's still a big difference. Vast outperformance. Why? Because of the Mag 7, basically. The largest companies have driven all of these returns, or a big chunk of these returns. Now, as you all know, back in 2000, the top 5 companies were 15% of the S&P. That was the peak of 2000. Today, the top 5 are 28%. Guys, I don't know what's going to happen. Nobody knows what's going to happen. But you see this stat and you think to yourself, wow, is this sustainable? Is it possible that the top companies in the S&P really continue to drive market returns for a long period of time? Maybe. Is it possible? For sure. Is it probable? That's why I have the question. So even though there's a disconnect right here between the equal weight and the regular S&P, I think that's driven for those top 7 stocks. Now, let's go back to when the RSP started from day one. Again, not including dividends. And the dividend seems to be better on RSP versus SPY. This is going back to 2003. You might sit there and go, Paul, it's not that much of a difference. RSP's only outperformed by a little bit. Yeah, that's what the last 3 years, 2.5 time return extra from the S&P versus RSP. And this doesn't include the dividend along the way and reinvesting that dividend. So I look at this thinking to myself, okay, maybe during bear markets, this probably does better. I mean, look at this chart here. Great financial crisis was the first time that they kind of equated out. Then big surge, drop here. So I think the key is, how can you buy it? Maybe you should start adding to it after the big drops in the market. I don't know. But you remember, I used to talk about QQQ all the time. And I said, listen, I love QQQ. Exposure to tech stocks. Tech stocks can grow faster. They can go bigger. You don't have to guess which one it is. But QQQ is currently at a very high valuation and multiple. Could it be okay? Sure. Tech stocks are great about compounding and building on themselves. Low capital businesses. You don't have to invest a lot of money to really grow that profit. I look at this saying, listen, I don't think anybody should replace any sort of ETF all at one time, but is this an idea for people to sit there and put a portion of their money in? I think so. For me personally, I look at it going, this could be an opportunity to sit there and when times look tough to get better exposure on the smaller companies. Because remember, the benefit of this is one major thing. What's more likely to grow fast? A small company or a large company? Obviously a small company. Smaller companies can compound and really do great. So in RSP, it's going to give more value to the smaller companies that can keep on compounding. Now, the downside of that is every quarter, if one has done very, very well, it's going to be taken back to the normal 0.2%. So even if one has gone up and doubled in a quarter, It's going to take some money off the table. Some of you might be like, that's a great idea. That's good. I don't want to have this thing double and then all of a sudden I'm still waiting for it and it crashes down. But these are the differences that happen out there. Now, one very popular video that we've done was about schd. schd is a very, very popular fund ETF from Charles Schwab, high dividend yield, provides a lot of dividends for people. How much dividend? 3.5%. versus RSP at 1.55%. Big dividend difference. Now, this is the returns of both these funds going back as far as they could, which SCHD I think started in 2011. And look at the returns. Very similar. These include dividends in this. So you're looking at this saying, okay, it could be an opportunity here. But remember, dividends are taxed inefficiently. So this is not including taxes. You might want to consider this ETF RSP versus SCHD, because you're looking at these returns, you're going, hey, they're basically the same, but I'm not going to have as much tax liability from RSP versus SCHD. Now, I've looked at it, and RSP beats SPY, not by much, and that's with that last 3 years being really, really crappy for RSP versus SPY. So let's assume you can get 0.3 or 0.5% difference every year in returns. I'm not saying that's the case, but over time, that can really add up to a lot of money. Let me show you. Our retirement calculator here is an incredible way to sit there. And I'm the #1 user of retirement calculator in our entire program. And the funny part is I plan on never retiring. But it's a great way for me to know I'm on my goals. And two, when I'm excited to go make more money, go, Paul, you don't need to go add more stress to your life if it's not going to make your life any better down the road. If you already have enough, why do more? And I know that sounds crazy, but that's the way it is for me. And I like to remind myself of this. But a lot of people out there like to use retirement calculator to say, am I on the path to where I want to go? And it'll tell you, if you're not, exactly how much to put in every single year extra. So let me show you an example situation. So I put in a scenario here. Age 35, retiring at 65. So you have 30 years left. Now remember, our average viewer is 25 to 45. That's why I picked 35. I have no idea what the average user we have has in their savings. I'm putting $100,000 in here. I'm sure a lot of people who watch our channel are more, and the ones who are less probably have a reason for that, and they're just trying to build that up, which is awesome. But let's say you save $15,000 a year, you increase that savings by 4% per year, you get 9.5% return, because the market average is 9 or 10%. So I'm calling it 9.5% return just in the S&P 500, not RSP. 6.5% during retirement, you're going to live to 90. 3.5% inflation, your current income is $75,000, and you want to have 80% of your income in retirement. Because most people's expenses decrease during retirement because they have paid off cars, paid off houses, things like that. So they don't have kids anymore. Generate, do you have enough for retirement? Absolutely. At retirement, you have $5.3 million. That's incredible. With $100,000 today, saving $15,000 a year for 30 years at 9.5%. Equivalent to 1.9 today. And guess what? Upon death, it keeps growing. You're at 11.23 million at the age of 90. And it keeps growing all along the way. Wonderful. Now, remember, 5.3 million and 11.2. Let's change the annualized return to 10%. Let's say you get 0.5% more by properly investing in RSP. Hit generate. Do you have enough? Absolutely. Instead of 5.3, 5.23, you have 5.9. Okay, that's not bad, guys. That's all compounding and growing over time, tax-free in your IRA or mutual or your 401k. And upon death, 14 million, an extra $3 million. That's the power of these small differences. Now, again, I'm not testifying that RSP is going to outperform by 0.5%. I'm just throwing a hypothetical out there and also showing you this is why it's important to dollar cost average into low cost ETFs and just let them compound for a long period of time. Now, remember, guys, my strategy isn't always just buy one ETF, be done. I believe there's a compilation. Like I said earlier, QQQ gets you exposure to fast-growing tech that can compound itself very quickly. SPY, just a normal S&P one. And then RSP here, potentially adding to sit there and kind of balance out some returns. Now, if you want to see my perfect ETF kind of portfolio, watch this next video. Thank you for your time.